At some point during residency, usually after your first few paychecks, someone is going to ask you a question. Maybe a family member, maybe a co-resident, maybe a financial advisor who somehow found your email address. The question is going to be, should you buy a house? And the answer you are going to get from most people who offer one is usually going to come from one of two places. Either a general belief that buying is always better than renting, or a general belief that residents should never buy. Neither answer is doing the math. This video does the math. Honestly, for both sides. For a resident specifically, not for a generic home buyer, not for an attending, not for someone with no student debt and a stable 10-year timeline. For you, right now, in training. By the end of this video, you will have a clear framework for making this decision based on your specific situation, not based on what someone else thinks is always true. Before the math, 2 questions, because the answer to both of these changes the entire calculation. First question, how long will you be in this city? Not how long your residency is. How long will you actually be in this specific city after your residency ends? More than half of residents move after training, fellowship, job market, family, lifestyle. The reasons are many, but the data is consistent. The city where you do your residency is often not the city where you build your career. And if you are buying a home you plan to sell in 3 years, that changes the math entirely compared to someone buying a home they plan to stay in for 15. Question 2. What is the actual monthly cost comparison between buying and renting in your specific market? Not nationally, not on average, in the specific city where your program is located. Because in some cities, particularly smaller markets where home prices are relatively low and rents are relatively high, buying on a resident's salary is genuinely feasible and the monthly numbers can make sense. But in other cities, major metropolitan areas, where median home prices exceed $400,000 or more, the monthly cost of ownership can be dramatically higher than renting on a resident's salary. The national conversation about buying versus renting is almost useless to you. The only conversation that matters is the one about your city, your salary, and your timeline. Let me make the strongest, honest case for buying during residency. Because there are real situations where it makes sense. Point 1. You are building equity instead of paying someone else's mortgage. When you rent, every dollar of your monthly payment leaves your balance sheet. When you own, a portion of every mortgage payment reduces your loan balance and builds ownership in an asset. And over 3 to 5 years, in a stable or appreciating market, that equity accumulation is real money that renting does not produce. Point 2. You lock in a fixed payment in an environment of rising rents. Rents in most American cities have increased significantly over the past decade. A fixed rate mortgage payment does not change. And if you plan to stay in the city for more than 5 years, between residency, fellowship, and early attending years, Locking in a fixed payment now protects you from rent increases that are otherwise outside your control. Point 3. The physician mortgage loan. Most residents are eligible for what is called a physician mortgage, a loan product offered by specific banks and credit unions designed specifically for physicians and residents. These loans typically allow 0 to 5% down payment with no private mortgage insurance, a fee that conventional low down payment buyers typically pay that can add hundreds of dollars per month to their payment. They also often exclude student loan debt from the debt-to-income calculation in ways that conventional loans do not. Point 4. Real estate can appreciate. In markets that have historically appreciated, and many have, a home purchased on a resident's salary in year 1 may be worth meaningfully more at graduation. And if the appreciation is sufficient, it can offset the costs of buying and selling and produce a return. This is not guaranteed, but it is real and it happens. These are genuine arguments. In the right market, with the right timeline and the right loan product, buying during residency can be the right financial decision. Now the other side. The strongest, honest case for renting during residency. Point 1. You do not know where you are going after residency. This is the most important single factor in the entire decision, and the one most people underweight when they are excited about the idea of buying. Fellowship applications, job market conditions in your specialty, a partner's career location, a family situation that changes, the attending position you want most, being in a different city than where you trained. More than half of residents leave the city where they trained, and if you buy a home, then move in 3 years, you are not just selling a house. You are paying 6 to 10% of the sale price in transaction costs, agent commissions, closing costs, staging, repairs. On a $400,000 home, that is $24,000 to $40,000 that simply disappears. Point 2. Buying is expensive up front and expensive to exit. Even with a physician mortgage requiring no down payment, closing costs on a home purchase run 2 to 5% of the purchase price. On a $300,000 home, that is $6,000 to $15,000 paid at closing. Money that does not build equity and does not come back. Point 3. Flexibility has real financial value. Renting gives you the ability to move for a better fellowship, to take the attending job in a different city that pays $50,000 more per year, to follow a relationship to a new location, to change your specialty plans without being anchored to a property you need to sell first. That flexibility is not sentimental. It is financially quantifiable. If renting allows you to take a $50,000 per year salary increase that home ownership would have made you hesitate to pursue, the rent you paid was one of the best financial decisions you ever made. Point 4. Home ownership has hidden costs that renting does not. Property taxes, homeowners insurance, HOA fees if applicable, maintenance and repairs, which financial planners typically estimate at 1 to 2% of the home's value per year. On a $400,000 home, that is $4,000 to $8,000 per year in maintenance costs alone, costs that renters never pay. Renting is not throwing money away. Renting is paying for housing, flexibility, and the freedom to make career decisions without a real estate transaction standing in your way. Here is the calculation that most people do not run before they decide to buy during residency. Assume a home purchase price of $350,000, a 3-year residency, and a move after graduation. Closing costs at purchase, approximately $8,000 to $15,000, gone. Maintenance and repairs over 3 years at 1.5% annually, approximately $15,000 to $16,000. Property taxes over 3 years, varies by location, but in many markets, $8,000 to $15,000 over 3 years. Costs to sell at graduation, real estate agent commissions, closing costs, minor repairs and staging, typically 6 to 10% of sale price. On a $350,000 home, that is $21,000 to $35,000. Total transaction and ownership costs over 3 years before any mortgage principal paydown or appreciation, $50,000 to $80,000. Now, for your home to break even on a 3-year horizon, let alone come out ahead, it needs to appreciate enough to cover those transaction costs, plus the equity you built through mortgage principal payments. And in some markets and some periods, that happens. In others, it does not. The point is not that buying is wrong. The point is that you need to run this specific calculation for your specific market before you decide, not after. One thing worth understanding specifically: whether you ultimately decide to buy or rent, is the physician mortgage loan. A physician mortgage is a loan product offered by specific banks and credit unions, designed for physicians and dentists, including residents and fellows. 3 features distinguish it from a conventional mortgage. First, 0 to 5% down payment with no private mortgage insurance. Conventional borrowers who put down less than 20% typically pay PMI, an additional monthly fee that can run $100 to $300 per month, depending on the loan size. Physician mortgages waive this requirement. Second, student loans are often excluded from the debt-to-income ratio calculation. Conventional lenders count your student loan payments against your borrowing capacity. Many physician mortgage lenders do not, or count them differently, which allows residents with significant student debt to qualify for a mortgage that conventional guidelines would not approve. Third, they often allow a signed employment contract in place of income history. Conventional loans require 2 years of tax returns showing your income. Physician mortgages can often be approved on the basis of your residency contract alone. Useful for anyone purchasing during the transition between residency and attending practice. 2 things to know. Physician mortgage interest rates are sometimes slightly higher than conventional loan rates. And the no down payment feature means you start with 0 equity, which amplifies the financial risk if the market declines or you need to sell quickly. The physician mortgage is a useful tool. Like all tools, it works well when used in the right situation and creates risk when it is not. So how do you actually make this decision for your specific situation? 3 questions. Answer them honestly. The answers will tell you what to do. First question. Question 1. How confident are you, on a scale of 1 to 10, that you will still be in this city in 5 years? If your answer is 8 or above, the timeline argument for buying gets significantly stronger. If your answer is below 5, the transaction cost math makes buying risky, regardless of what the market does. Second question. Question 2. What is the price to rent ratio in your specific city? Divide the median home price in your area by the annual cost of renting a comparable property. If the ratio is below 15, buying is generally more favorable. If the ratio is above 20, renting is generally more favorable. Between 15 and 20, it depends on your timeline and your personal situation. This ratio is one of the most underused tools in the entire buying versus renting conversation. Third question. Question 3. Can you afford the monthly payment on a resident salary comfortably without it creating financial stress that affects your training? Not technically on paper, comfortably in practice. Because a resident who is financially stressed about a mortgage payment is a resident whose attention is divided during training. And that has a cost that does not appear on any spreadsheet. If your answers are high confidence on timeline, favorable price to rent ratio in your market, and comfortable affordability on your current salary, buying may make sense for you. But if even one of those 3 answers is uncertain, renting is probably the lower risk decision until that uncertainty resolves. The buying versus renting debate in medicine is usually framed as a values question. Are you the kind of person who builds equity, or the kind of person who values flexibility? But it is not a values question. It is a math question. And the math has a different answer depending on your city, your timeline, your salary, and your career plans. Nobody hands you that math in orientation. Nobody walks you through the price to rent ratio for your specific city, or the transaction cost calculation for a 3-year hold. You are expected to figure it out on your own during one of the busiest periods of your life. That gap between what training provides and what practice requires is what this channel covers every week. Subscribe for a new documentary every week. And if you know a resident who is facing this decision right now, send this to them. The math is the same whether or not anyone walks them through it. At least this way, they will have seen it.